So Jeff and I we're going to talk about kind of just an update overall on the COVID-19 impact and some GAAP considerations that go with that. So I'm going to give a quick update on the COVID EIDL program, the employee retention credit, the accounting for that, refresher on the PPP loan accounting. Hopefully everybody has that one down, but talk about it again. The employer payroll tax deferral, that's coming up for people that did decide to defer those payroll taxes. Asset impairments, going concern, exit and disposal activities, debt restructuring and covenants, lease concessions, and some additional considerations. So Jeff and I will be splitting up these topics. So first off, the COVID EIDL program. So they made a change to the EIDL program a couple months ago. And so if you had the opportunity to get the EIDL loan, you were probably limited to about $500,000 if you even got it. And so they came back because there's been extra money added to the funds, and you are now eligible to get up to $2 million. And so a lot of this kind of, I work a lot in the restaurant space, and so that restaurant revitalization fund did not fund as many people as they had hoped. Like maybe a third of the people that asked for funds got it. And so I think that was one of the drivers of this COVID EIDL programs, as this being an alternative for capital for those businesses. And so there's some improvements that were made. So it does allow for the prepayment of your bank debt. You can repay your federal loans, but you cannot prepay your federal loans. I think a lot of people are kind of forgetting that. Like they may have a lot of SBA 7A loans. And they're like, oh, I'll get the EIDL and I'll pay off those 7A loans. You can't. You can use the money to make the payments, but you can't pay it off. But you can bank loans. Use that to pay it off. In terms of eligibility, just as a refresher, you have to have been in business in 2019, less than 500 employees, and the calculation is basically 2019 sales less 2019 cost of sales times 2, up to $2 million. And there was a 24-month deferment. So if you had already gotten the EIDL loan, that 24 months starts from the initial date of that loan. And it specifically says you cannot use it for business expansion. But there's many other things that you can use it for. So, I mean, pretty much operating expenses, payroll, rent and mortgage, utilities. So lots of different things. Certainly you can't double dip on things. So if you use money for payroll that was covered by the PPP, that's not payroll that you can use for EIDL. So, but there's still a big, long period of time that you can use that. So if you are interested in that, and definitely decide if you are, because the program ends at the end of December of this year. So if that's something you're interested in, and you already have an EIDL loan, you can go back into the site and request an increase to your EIDL loan. And if you're a new applicant, then just log into the portal and start the new application. But again, that ends at the end of this year. Any questions on the EIDL? So the employee retention tax credit. So if you were lucky enough to get take advantage of this program, because it did provide quite a bit of refunds to people that were eligible for it. But the big question that came up was, how do I account for this? And so, we found this is kind of an unknown, like how do we account for this, like the PPP? And so it does fall under IAS 20. In terms of accounting, you accrue it once it's probable. And so certainly you have to go through the whole calculation to see what it is, make sure, I know our team has been helping a lot with the employee retention credit, making sure that in terms of eligibility, if you've met the revenue decline or you had a partial shutdown, all those things need to be documented. But when you do record it, you do have two options. It can be either recorded as other income or as a reduction of payroll expense. One caveat to that is if you did choose IS 20 for your PPP accounting, that's where you chose to treat it as a grant income. You would have to follow whatever method you recognize the PPP in your income statement. You'd have to recognize your ERC the same way. And so I think most people still recognize that as other income. That's the preferred method. Just for comparability, just pull it out because it'll be something that's going to look a little odd next year when you go comparing yourself to it. And then just for tax, the ERC is presented as a reduction of wage expense.
Yeah, Dustin, if I could just add real quick, so the employee retention credits, this is easily the #1 question that's coming into GBQ 911 bat fund in terms of how do I do this? Am I eligible? How do I account for this? And I just want to emphasize what Dustin said. There is not a specific US GAAP statement on this that says account for it this way. So you have options. What we see in practice is probably, vis-a-vis the public companies, maybe about 2/3 are electing to present it net against payroll expenses, and about 1/3 are other income. So either are permissible, as Dustin said. Our recommendation, all things being equal, is to put it in the other income, just so it gets a one-time, non-recurring, perhaps significant item just out of your, what I'll call normal P&L, so it doesn't cloud the year-over-year comparabilities. When you have things like M&A, liquidity events, if something's buried in the footnotes, a lot of people aren't reading the footnotes except for accountants. And so by calling it out specifically on your face income statement, it just mitigates the risk that something could be miscaptured that it shouldn't at the end of the day.
Yep. All right, let's do a refresher on PPP loan account. So like I was talking about earlier, so you had a choice of recording it as debt or as grant, or as a government grant. So when we talk about treating it as debt, basically on day one, you recorded it as debt on the balance sheet. Those P&I payments were deferred until the earlier forgiveness has been determined by the SBA, or 10 months after the end of the cover period. And I would think at this point, everybody is probably at the end of the 10 months after their covered period. So if you haven't requested forgiveness, you probably are in a situation where you need to start making P&I payments. If you're in that situation, you probably should be requesting forgiveness as soon as possible. And that monthly interest should have been accrued from day one. And also, I guess things to not forget is just the related debt issuance costs, which would include your accounting and legal fees, prep costs, and any costs that you pay to advisors during that time. So that's when you're accounting for this debt. I would say, I don't know, Jeff, would you say probably 90% of our clients treated it that way?
The vast majority. I mean, we tended to see the grant model accounting more so in the nonprofit space, just because within that industry, they were more used to those types of programs and
right,
kind of the qualitative aspects of that type of accounting. And then the other 2% just helped them make a covenant.
Right.
Or so they thought, right, until it got back down. So, but kidding aside, yeah, I'd probably say 90% of companies were treating it as debt and just holding it until they actually received the forgiveness and then washed it through the P&L at that point in time.
Yep. Okay. All right. In terms of the forgiveness accounting, so certainly you most likely work with your lender, or the SBA opened its own website to facilitate the forgiveness process. Certainly there's a lot of requested information. And just to remember, I mean, the extinguishment only happens after you've been legally released. And so that can take a while. Like your bank has 60 days to make its decision, and then it gets forwarded on to the SBA, and they have another 90 days to make their decision. But when it's all said and done, you should get a nice formal letter from the SBA that says that you have been released from this obligation. And a lot of times I just saw emails kind of going back and forth with like maybe the bank, but there is an actual official SBA letter that shows that you have been released. So if you haven't gotten that, reach out to your bank and ask them for that. If you are still in the process of waiting for forgiveness, there may be a chance that maybe there's a risk that it may not all be forgiven. So if there is a risk that it may not all be forgiven, you may need to record a reserve once that's probable. So hopefully that's not the case. I really haven't heard too many cases where the loan has not been forgiven unless you made a calculation error of some sort. So in terms of the accounting practice for forgiveness, you have the loan on the books, you have accrued interest, and you have deferred finance costs. So once you have received forgiveness, remove the loan, debit that, debit accrued interest, get rid of the deferred finance costs, and credit beyond forgiveness. So hopefully everybody has that one down. Probably have your PPP2 loan if you were eligible for that. So that might be in the works as well. I know quite a few of my clients are working on the forgiveness for that right now. And then for those that did record it as a government grant, so certainly this was allowed. And like Jeff said, a lot of nonprofits treated it that way. So that's normal practice for them. I know I had a couple of for-profit clients that did treat it this way as well, but basically it just gets recorded as deferred income liability on day one, so not debt. And then as you were using the funds that it was eligible for, it just kind of depleted that deferred income liability. And again, you have the choice of either showing it separately as a separate line item in the P&L or against the line item that it went against. So big picture on it, debt versus grant. I think we talked most about it there. I think in terms of your dealing with the bank, just making sure that you know what the bank is expecting for documentation. I have seen some banks push back pretty hard on, it has to be this documentation. So, and a lot of times, the banks may not know it as well as I think they do. So I know we've had our expert get on the phone with them and kind of talk them through, this is actually what you need. And that has certainly helped a lot. One thing to keep in mind, if you are eligible for the employee retention credit, make sure there is a strategy there on how much payroll to use for like PPP2. And even if you haven't gotten PPP1 forgiven yet, there's a strategy there as well. So, because the thing with the employee retention credit is you cannot double dip on the payroll. So you want to be able to use as much payroll for the ERC as possible, which ultimately means using no more than 60% for payroll for the PPP, which is required. So we've seen a lot of people make changes to their PPP2 applications to take advantage of that. In terms of future reporting, so the second bullet here, mark that out because I had forgotten to take that one off from last year where everything is now fully deductible for both expense and it's not recognized as income. But the first one there, like on debt covenants, and Jeff was talking about a little bit earlier, make sure you understand how the forgiveness impacts your debt covenants. Like if you're picking up this huge income and that is the only thing that's allowing you to pass your covenants, it may not be, it's probably something that has to be backed out. So, but certainly a conversation you need to have with your lender. The employer payroll tax deferral. So some companies did take advantage of this where basically you were allowed to defer your payroll taxes and then pay 50% on 12/31/21 and 12/31/22. So for those companies that decided to do that, you should have had an accrual on the books for those, but at least half of that is coming due here next month. So before we jump to the Jeff's portion, there was a new ASU that came out just yesterday. So it's ASU 2021-10, and it is talking about how to disclose government assistance. And so, Jeff all along has come up with great disclosures for our audit teams and for our clients of what that needs to be disclosed, and really I think hits most of the points that they have put out there. And so basically, it applies to all companies except non-for-profit and benefit plans. It's technically effective 2022, but certainly early application is encouraged. And I think the key thing to remember, it doesn't change the way you recognize the PPP forgiveness or the ERC. It's strictly a disclosure update. And so in terms of disclosure, you have to disclose the nature of the transaction, your accounting policy, the balance sheet P&L line items that were impacted in the amounts for each line item, the terms and conditions, which is the duration or period of the agreement, any commitments made, provision for recapture, other contingencies, and it is applied prospectively or retroactively. So that just came out yesterday, so I'll try to add a slide on that before Kyrie sends out the follow-up slides for tomorrow. Okay.
So basically the footnotes are getting longer. Wouldn't it be nice if they got shorter sometimes? They just grow and grow. Okay, so while I get situated here, I have to let you know I wasn't supposed to speak today. I was actually kind of bummed about it. And the way I found out is when the email went out with the invite, it had all the GBQ panelist speakers, and they were looking great with their coats and everything. I wasn't on it. So I asked Jessica Weeks, shout out to her for coordinating today. I said, Jessica, you missed me. I know I'm not the best looking person, but I don't think I'm like bad looking. She told me I had the year off, so fine, it's good. A couple days ago, my man Dustin pinged me and said, good news, got a spot. Do you want to speak? Said I'm in. Bad news, you got to talk about COVID-19 GAAP accounting at 3:35 p.m. in the second to the last module. So it is what it is. But again, it's good to see folks. Thanks to the folks online for joining. Okay, so we're calling this COVID-19 accounting implications. This whole landscape has been evolving. You could probably just as easily in today's day and age call it supply chain disruption accounting implications. I can't find workers accounting implications and everything in between. So it's just kind of this big kind of bundled, unusual time that we're in. And so what I usually tell our young folks is we have all of GAAP accounting that's out there, and the majority of the time, only half of it applies. But when you get into recessions or things like the environment that we've been in, like the dark underworld of accounting rules starts to get triggered. And so we're going to go through these in more of a rapid fire type format. Probably spend an hour plus on each one of these individually, but so this is just going to be the highlights. The objective is really just to hopefully trigger something in your minds as you prepare and ready yourselves for year end of something maybe that you hadn't thought of that maybe warrants a little bit more consideration, time, and attention. And certainly some of these are very technical, hairy topics, so please reach out to your GBQ team member anytime, myself, Dustin, we'll do our best to help you out. So the first kind of big topic that we'll talk about broadly speaking are just asset impairments in general. The thing that I'll point out before we get into each of these topics individually is that the sequence by which these assessments are performed is very important. So my young son, before he goes to school, I say put on your socks before you put on your shoes, put the shirt on before you put your coat on, so forth and so on. It's very important that we have a similar sequence here in terms of kind of how these are performed. For things like your goodwill, your long-term assets, these are going to be more holistic entity level type assessments that unless you get your AR, your inventory, and some of the other more kind of routine granular accounts trued up and straightened out first, you're going to get to bad outcomes and answers at the end of the day. So first, wherever we are with keywords, here they are, inventory and strategy. So I'll sound the buzzer for the online folks. Please pay attention for your two keywords. And by the way, if there are questions, either here in the room, shout them out. Online, ping them to our friend Kyrie there. If your question is, are you done yet? I can go much longer. Okay, inventory. So for those of you involved in manufacturing space, the first one is pretty basic. We all learned this in, freshman year of college accounting. You record inventory at the lower of cost or market. A couple items I want to point out. Market, or what I'll say is net realizable value, is not selling price. It's not the cost of my inventory and what I'm going to sell it for. Oh, the sales price is higher. I don't need to do anything. When we talk about net realizable value, this is your selling price less cost to complete, cost to sell. If you have WIP inventory, of course, you're probably going to sell it for more than the carrying cost of your WIP, but you got to contemplate the cost to complete, what other materials go into it, labor, overhead, so forth and so on. In this environment, it's more about excess inventory is what we're seeing. So you've got the product ready to go. You've got lots of raw materials in place, just waiting to manufacture product, sell to your customers. But somebody somewhere in the supply chain is waiting on a little computer chip. And so we are seeing companies evaluate those inventory levels, perhaps if there's excess quantities, liquidating them in some way, shape, or form. And that's when this lower cost or realizable value is really starting to come into play. In terms of the second bullet there, firm purchase commitments, this is not necessarily kind of an accounting event per se, the majority of the time. To the extent that you've got long-term supply arrangements to procure materials and lock in capacity and things of that nature, those are typically disclosure-only items. When the accounting is actually triggered is to the extent that you feel you have a probable loss. So in those long-term commitments to lock in that capacity, if ultimately in this environment you don't anticipate that you're going to leverage the full purchases that you're committed to and perhaps have some sort of breakage, penalty or fee or whatever the case may be, really once that's probable, you need to kind of accrue that, and not kind of, you need to accrue it in your financial statements at that point in time as some sort of kind of liability reserve for that probable loss. The last item here on this slide is actually very relevant in this environment, and it's something that oftentimes is overlooked. So again, kind of accounting 101, you record and maintain your inventory at the cost to build said inventory. So you've got raw material costs, that's obvious. What companies need to do from a cost accounting perspective is incorporate labor and overhead, and depending on the system and your methodologies, labor and overhead variances, purchase price variances, usage variances, things of that nature. Typically, those aren't tracked on a lot by lot basis unless you've got an ERP that's able to do that. So most organizations have some sort of high level calculation based on inventory turns and things like that. The challenge that comes into play in this environment is many companies are not operating nor selling at full capacity. So if you let those calculations just run on autopilot and you kind of do the math, I'm producing less units, I'm selling less units, but a lot of my fixed costs are the same, you're going to potentially overcapitalize what's going into inventory. And so long story short is those types of calculations, and those of you that have those manual kind of variance analyses for accounting purposes, it's got to be based on normal capacity, in a non kind of COVID current environment perspective. Couple quick things on receivables. Most everyone participating in this meeting probably has some policy and or reserve around an allowance for doubtful accounts. So your account's receivable, you put a reserve against it for what you don't expect to collect. So, just by nature, you don't even really think about the underlying standards, but the underlying standards are you accrue that once it's probable and estimable. Most companies have a generalized kind of aging policy whereby once receivables hit, for example, 90 days past due, they reserve some set percent. What we're seeing in this environment as terms are changing, maybe they're getting extended, maybe you're pulling up the collection, the due dates, so to speak, that those reserve percentages may need to be updated and refreshed. And what we're advocating for clients is to not only have that type of policy in place, but do some sort of specific reserve analysis. I think most companies are in this environment, is really kind of evaluating your customers kind of on a case-by-case basis irrespective of whether they've reached the 90-day threshold, in my example, to the extent that you've got negative indicators around collectability, you really should be setting up some sort of specific reserve for those customers. The last item I'll mention here is subsequent events. So again, we have recognized and non-recognized subsequent events, or new information that may come to light post-quarter end, post-year end, so forth and so on. To the extent that you have a customer that maybe you reserve 50% of the receivables, and then post-year end, pop, they go bankrupt, what do you do from an accounting perspective? Well, what the rules would suggest is that's new information. However, it relates to facts and circumstances that existed as of your balance sheet date. So it's another way of saying that you actually have to pull that expense forward and then take that loss as of your year-end or quarter-end reporting date. On the flip side, let's say you reserve, and then after year-end or period end, you actually receive everything. Do you get to take that gain and that income back? The answer oftentimes is no. Lovely how that works, right? Accrue all the losses, but don't take that income. Let it be, right? So that's just something to kind of keep in mind as part of those AR reserve assessments. A couple really quick points on investments, because it's probably not going to be applicable to the vast majority of this audience, but for those of you that have investments in debt securities, things like bonds directly, not mutual fund bonds or bond ETFs, where you're actually holding corporate debt. To the extent that you have an accounting policy election to treat those as available for sale securities, which means that you're taking those mark-to-markets through equity, or what we call other comprehensive income, as opposed to the P&L, there is a requirement that the extent that you have what we call in our world, other than temporary impairment, meaning some sort of credit deterioration, something other than just your normal market fluctuations, that those expenses would need to go to the P&L as expense at that time. So to the extent that you've got treasury functions or somebody in your financial organization that's really kind of monitoring those investments, to the extent that they're significant, if you have these types of investments, you probably likely have a significant portfolio. Look for credit downgrades. Moody's, S&P, et cetera, is kind of the primary indicator as to whether you have one of these other than temporary impairments. Okay, we'll anchor on this slide for just a minute because these are probably two of the more complicated topics, and that's the impairment accounting models for long-term assets and goodwill. Let me just start by defining long-term assets. For the most part, this is going to be your property, plant, and equipment type assets. It could also be something on your balance sheet in terms of deferred commissions or an intangible asset like a trademark or something of that nature. But whether it's long-term assets or goodwill, the analysis more often than not will start with a qualitative assessment or evaluating indicators that may be out there. So to the extent that you lost a major customer, or if you have a history or pattern of recurring operating losses or cash flow deficits, things of that nature, you're likely going to trigger what we would call kind of a formal impairment assessment. So you kind of start there for both goodwill and long-term assets, how most companies apply it. Really kind of the next step is from a long-term asset perspective, again, the property and equipment and things of that nature, you don't immediately record an impairment. You have to first assess whether those assets are recoverable from a book value perspective. And so when I say recoverable, are the undiscounted cash flows that said assets are expected to generate over time, will that recoup or recover what's on your balance sheet in terms of net book value? So the question that naturally arises is, well, Jeff, my one piece of equipment, there's no way that I can identify individual cash flows that that asset is generating. And so what the guidance would suggest is you kind of move up the chain. And what most companies end up doing is performing some sort of impairment assessment at the enterprise level or at the overall business or a particular plant if you're a multi-location facility. So the exercise essentially becomes, forecasting your P&L, which is used as a proxy for forecasting cash flow, whether it's EBITDA or, a similar metric, and comparing that to the net book value of your assets. When you do that holistic kind of impairment approach, a natural question is, well, how many years do I project out? If it's a long-term asset like equipment, it is the remaining useful economic life of whatever the quote primary asset is in that group. So for a manufacturing facility, the primary asset might be that key piece of equipment that really is the driver of your business, a press machine. If you're in the steel business, it's not necessarily the copier that's in the corner of the room, right? So that is really the starting point. To the extent that you fail that and that recoverability test does not pass or you're upside down, then you would actually do a formal fair value assessment. Appraisals, discounted cash flows, things of that nature. Okay. Goodwill is similar, but a little bit different. There is no intermediate recoverability step that I just outlined. If you've got indicators of impairment, meaning more likely than not that you're not going to, that your goodwill may be impaired, you're going straight to a fair value exercise. The exercise there is really kind of evaluating the fair value of your business. It could be based on a discounted cash flow analysis. It could be a market multiple type approach in terms of what are companies in your space trading at or have sold for in terms of an EBITDA multiple, things of that nature. And once that fair value is determined, that's compared to the net book value or the net equity or net assets of the overall business. And that delta there, if it's upside down, would ultimately become your goodwill impairment charge. So clear as mud, right? Okay, going concern. Everyone's favorite. This is when your audit firm gets to come in and tell you your business is going to go bankrupt and fail when you've been doing it for 20, 30 years of your life, right? So the first thing that I'll mention in terms of going concern is this is not only an auditor requirement, it's also a requirement of management and financial statement preparers. So it's really kind of a dual assessment. And what I'll say in terms of going concern is, to the extent that disclosures are triggered as part of this analysis, that does not in and of itself mean that your business is going to fail. The spirit of these rules in this accounting guidance is really, again, in the spirit of transparency and disclosure, is to provide a mechanism to alert financial statement readers that there is some uncertainty around the ability ultimately to settle future obligations. And the way that we define that within the construct of the standard is to the extent that it's probable that an entity will not be able to meet its obligations in the next 12 months, the next 12 months being from the date that your financial statements are actually issued, not necessarily year end, then that would constitute what we call, or what the standards define as substantial doubt. Okay. So to the extent that you've gone through the analysis and there are conditions that suggest that substantial doubt may exist, the second part of the analysis is to look at mitigating plans, strategic plans, liquidity plans, things of that nature that the management team has in place to ultimately mitigate that substantial doubt. So if you've got additional facilities out there that you could tap into, perhaps one of your business owners has committed capital, or there's liquidity available on the line, or you've got new products that are being launched. There could be a variety of factors, but to the extent that those plans mitigate that substantial doubt, then the disclosures become much more onerous. The requirements are, in that scenario would just need to be that you alert the reader that there are some negative conditions that are out there, and here's management's plans to address those, and you're kind of done at that point. To the extent that there aren't plans that mitigate the substantial doubt, that's when you'll have an emphasis of matter in your audit report that calls it out, and in the footnotes themselves, you'd have to use the more kind of negative terminology, I would say, in terms of actually indicating that substantial doubt, that actual phrase, substantial doubt, exists as of your financial statement date. A few quick items here on exit or disposal activities. Question that comes in from time to time, particularly in environments like this, is to the extent sales are slow or non-existent in certain cases, some business owners will actually idle facilities. And so the question becomes, well, do we stop depreciation? What do we do in that case? And so what the accounting rules would suggest is that you can, in certain cases, suspend that depreciation, but you really need to go back to the impairment analysis I mentioned, really, a lower cost or what's ultimately the fair value of that location. So it's really a mechanism to trigger that impairment analysis. We're not seeing, quite frankly, a lot of employee termination and severance. Everybody's looking for workers, but in the event that this applies to you all, any sort of severance agreements, this is kind of the mid bullet at this point, you would accrue those in full once it's communicated to your employees, to the extent that there's no ongoing service requirements. If the arrangement is such that, somebody will assist for the next 6 months, and then there will be involuntary terminated, you would actually take the expense over that 6-month period. But if it's a normal kind of involuntary termination, you would accrue it all up front once it's actually communicated to the employees. Last item on this slide, in terms of exit costs, just a quick item here on leases. Everybody's working remotely, it seems. Companies are downsizing their physical footprint in terms of office space, perhaps canceling leases, certainly not renewing them, and others. To the extent that you cancel a lease and there's some sort of breakage costs there, you would have to accrue that all up front once you cancel that lease, with one caveat. This is from a fair value market participant mindset. In addition to that reserve, you actually would reduce that down and net it with anticipated sublease rentals, irrespective of whether you actually have a sublease arrangement in place. Again, this is kind of this market participant fair value premise that's applied to these particular rules. In terms of debt restructurings, to the extent that any of you are going through some sort of modification or refinance or extending the terms or negotiating a different interest rate, there are rules around this. We saw a lot of this in 20, less so in 21. One item to note is that there was some relief guidance that was put out around what we call troubled debt restructurings, which had really complicated accounting, which we won't get into. But ultimately what the FASB said is that a lot of these COVID relief arrangements that were being entered into with lenders would not constitute a troubled debt restructuring, at least in terms of the GAAP accounting. So that leaves us with really a couple options. To the extent that your new debt is substantially similar to your existing debt, you would treat that as a modification, meaning that any new fees that you pay to your lender for that refinance, you capitalize on your balance sheet as a deferred finance cost, leave what's on your balance sheet as a deferred finance cost, just amortize it over the new period. If the terms of your new debt are substantially different than your existing debt, then we would apply what we call extinguishment accounting. And you would write off all the unamortized deferred finance costs currently on your balance sheet and expense any new fees that are paid to your lenders. How do you determine what's a substantial difference or not? I'm not going to get into in detail here, but there is, they call it the 10% test, where you actually look at the cash flows under old and new debt, and there's a discount rate that's applied. To the extent that they're more than 10% different, you're in the extinguishment bucket. If not, you're in modification. Yeah, pretty complicated. Again, this is really just intended to alert you to things to think about as you head into year end. If this is applicable to you all, talk to your GBQ team member, reach out to your audit firm, and they will certainly help you out. Lease concessions, I'm going to skip a couple slides. During 2020 in particular, particularly within the restaurant space, there were a lot of concessions around leases and kind of extended rent holidays and things of that nature to kind of help out. Similar to the troubled debt restructuring, there actually is fairly complicated accounting rules on this topic. FASB stepped in and really simplified it to make things easier for reporting entities. And ultimately, there's two options that are afforded to you if this is applicable to you all. You can continue to apply the accounting as you've been doing it all along, so kind of that straight line rent expense approach. Or the second option, excuse me, is to, during that rent holiday, don't record anything and then just resume it again once the terms of the new lease arrangement come into play. So it's a continue on as you've been doing, or kind of a momentary pause is the way that I would describe it. Last slide here for me, unless there's any questions. Quick reminder on contingencies and contingency accounting. As I mentioned earlier, we kind of go two ways. If you have loss contingencies, you're always accruing those up front. If you've got gain contingencies, it's always wait until it's actually realized. So one question that comes into play and is asked of us from time to time is things like insurance recoveries. So we're seeing more companies file with their insurers things like business disruption claims. My plant shut down because my customer can't find computer chips. You know, I've incurred a loss, recover, et cetera, et cetera. The way that the accounting works for those types of insurance programs is to the extent that you've actually incurred a loss, meaning, here's an extreme example, your building burns down and you file a claim to recover, you're allowed to actually, even though it's a kind of a gain element, you are allowed to take that income up to the point of the loss that you incurred, so long as it's probable that you're going to receive that. For things like business disruption insurance that involve lost profits, conversely, that is a straight up gain contingency whereby no accounting entry will be recorded until you actually have that check in hand from your insurance company. So again, there's some subtle nuances within, but really the key being on whether you've actually incurred a loss or not. I think these last few bullets up here, there's nothing, particularly with the pensions, we're not seeing kind of big reductions in workforces in this environment. It's usually trying to find and build that back up. So I won't get into that one. But on the revenue recognition, just a reminder, with the new 606 rule that came into effect a couple years back, to the extent that you've got variable consideration, things like rebates, coupons, things of that nature that are being impacted by the disruption, you may have to change those assumptions in your Excel models and your workbooks to contemplate whatever the existing facts and circumstances are at this particular point in time. So that being said,
Jeff, we do have a few questions.
oh my God, did we have any questions at all?
We have a few, yes. This is a hot topic. So,
It's 4:01.
I know, we'll go quick.
Yes, please.
So first question, we qualified for ERC for Q3 2021 and our 941 marked to refund the amount, not to apply it to future quarters. So they're wondering, how will this refund be received? Will it be check or by some other means?
We need to get Sarah Goldhart back in there, don't we, Dustin? I know the answer to that.
I think they're getting, I don't know.
Okay.
But it could be like 9 months.
I'll tell you what, if you're gonna be on the line here for the last module, I will run downstairs because I don't want to get bad counsel on this and pull in my tax subject matter expert, and we'll get the answer here before the end of the last module.
Okay. Next question, the quarterly comparison dates for ERC is 2019, correct?
Yes. Dustin does not have a microphone, but he said yes.
Okay, and then real quick, the last question.
I'm sorry, just in the event that this goes off ERC, I can't remember if Dustin mentioned this or not, but the new infrastructure bill that was passed is now ending the program as of September 30th. I apologize if that was already mentioned,
No.
but that's somewhat new and recent information.
That's a good segue into this next question, that says regarding the booking of ERC when probable. Given the uncertainty with how this program works and the radio silence from the IRS, we're reluctant to record a receivable in the financial statements without something definitive. Especially since they just canceled the Q4 2021 credit and the fact they've always been taught to defer gains rather than be aggressive and accrue. So question, I guess, to clarify what we sort of already discussed was, would you recommend recognizing this or wait until you receive something back formally from the IRS?
Yeah, that's a great question, right? And so, oftentimes things can appear black and white, and there's going to be one universal answer that applies to all scenarios. But particularly in a situation like this, what I would encourage finance and accounting functions to do is to exercise your judgment on this based on your individual facts and circumstances, right? And a lot of our tax friends aren't in the room, so I'll go ahead and say this. It's like within the tax space, you could be more aggressive on certain things, and sometimes that's a good thing. And then other times you'll be less aggressive. And, as a management team, sometimes you want to risk on and sometimes you want to risk off, right? So depending on where you are on that spectrum, whether it's PPP, what some folks were claiming, and, ERC, particularly in these evolving areas, that's going to be, an assessment that you all will need to make as financial statement preparers. And, what I heard just in how the question was phrased, I didn't hear a lot of confidence in that. And so I throw out the term probable loosely, but, the way that it's defined in practice would be greater than 90% likelihood that you're going to do it and you comply, right? That's a high bar relative to something like more likely than not, 50-50, like, yeah, I think so, but maybe, this is like, no, we comply, we're gonna get it. To the extent that you've got some uncertainties around that, what the guidance would suggest is, don't accrue that receivable, and it's okay to, take that income when you actually had that cash in hand to resolve any of those uncertainties. Another entity, based on their facts and circumstances, may come to a different conclusion, and both could be right. And so, if it sounds like I'm beating around the bush and not giving Jeff squishy, typical auditor answer, some of that is intentional. Thank you, Trevor. But it is enabling you all as management teams, financial standard preparers, to exercise some judgment in this, which is ultimately what the standard setters want, is for you all to exercise judgment to have, as opposed to a prescriptive kind of black rule. What can you, Jessica, I'll ask you what that first question was, and then I'll circle back on the answer for that one. Okay?
Yeah.
All right. Thank you.